If the banking sector is not properly reformed, if the banking sector is not given its due importance and priority altogether, then automatically the banking sector will fall down. That will crumble the economy into pieces. Private bank will start putting in challenges to the public sector banks and ask them to take up reforms and innovations at a greater pace altogether. NPA, non-performing assets. Good morning and welcome to this session 5 on Unit 2. This is going to be a very interesting session in terms of management of banking and operations, and we are going to speak about the Narasimhan Committee recommendations, and this has got two parts to it. Now, the banking reform started way back in the year 1972 with the government coming into picture, but after that there was a lot of recommendations that started up in the year 1991 where we started coming out in terms of reforms. So let's go forward and try to understand what are that reforms that really changed the banking scenario to the modern global powerhouse. So moving forward, the banking sector right from the year 1991, India's economic crisis to its status of the third largest economy in the world by 2011. Right, now you have to just understand this position very clearly. In the year 1991, let me tell you, India's FDI position, the Forex Reserve, was less than $1 billion. We were literally struggling to get that sort of money inside India. In 2011, if you see, India's Forex Reserve almost go to $300 billion, and today we are standing at almost $500 billion in our reserve. Look at the massive growth that was possible to our country just because we opened up the gates in the year 1991 and started adopting the open economic system. In the year 1991, we believed that the only way to grow, the only way to bring in reform was only through liberalization, privatization, and globalization. So from the year 1991, say from 1992 effectively, what we had tried to do is that we had started reforming every single process for the economic development and with the banking sector in special. Now, the banking sector is such a sector for any country that without the banking sector, you cannot imagine the economy to grow at all. Banks are the financial powerhouses that can drive the economy to the next level. If the banking sector is not properly reformed, if the banking sector is not given its due importance and priority altogether, then automatically the banking sector will fall down. That will crumble the economy into pieces. So that's why we always bring in the banking sector as the topmost priority here. Now what happens is that during this period, recognizing the evolving needs of the sector, because we understood that, yes, even the banking sector requires a reform, requires a push altogether, we started coming in there. And what did we do? Actually, we brought in the Finance Ministry of Government of India to set up the various task factors with the task of analyzing India's banking sector and recommending legislation. The Finance Ministry wanted to see that whether the banking sector can be reformed, can be made much more flexible, open enough, where we can attract funds, where we can develop the economy altogether. And the answer was yes. Why? Because we wanted to bring in privatization in banks. We wanted to make the banking sector even more competitive. Actually, if you just go back and try to understand this process, before 1972, we had banks quite close to 953 cooperative banks in India, 447 state-owned banks, and we had hundreds of private banks that was running across our country. Now, when you look at this scenario, we were a country where we were the founders of banking industry from different states, from different angles, from different communities altogether. But in 1972, when the Nationalization Act came into picture, government's priority changed more towards the public sector union. They wanted to bring every single bank under the umbrella of Government of India undertaking tag. But then afterwards, what happened is that we wanted to go back to that same era where we wanted to break open the government legislations, licensing, and we wanted to come into a private sector economy altogether. So that is where we set up two expert committees under the chairmanship of Mr. M. Narasimhan, who had gone ahead and submitted some fantastic recommendations for the reforms of the bank. Now, they submitted their recommendations in 1990s, which is widely known as the Narasimhan Committee report of 1991, Part 1 and Part 2. And these recommendations not only help unleash the potential of the market, but also bring in massive reforms in the banking sector. Now, what we say is that today, the way Narasimhan Committee had given up the recommendations way back in 1991 itself actually helped us to sail through the global financial crisis that happened in the year 2007. Most of you might remember that in the year 2007 and 8, there was a global meltdown in terms of the financial services and act, and the mortgages rate really came down, crashing the US market completely. But India was able to sail through that crisis because of the Narasimhan Committee report's recommendation, which we have been following with our banks. Followed by, unlike the socialist democratic era, this is very, very important, of the 60s to 80s, India is no longer a part of the economy, insulated economy from the global economy or from globalization. Yet, its bank was able to survive in the 2008 factly because of the Narasimhan Committee report. If you see the protectionist kind of era that was there with our government way back from the 60s to that of 90s almost, the reason was that government was just trying to protect the environment, protect the system in such a manner that they wanted all the banks to be under the public sector control. They never wanted the system to go into the hands of private and become a monopoly market altogether. But what we wanted to see is that if the economy has to grow, you have to bring in competition. You have to go forward and tell people that yes, you will be able to do something really powerful enough. So that is where the Narasimhan Committee report was a very big support and help to the entire government, which could come back and tell people that how we can reform the entire system. Now, moving forward, what are the recommendations that was made by this great committee? Let's go one by one here. The first recommendation that they made is that establishment of a 4-tier hierarchy of banking structure with 3 to 4 large banks, including SBI at the top and bottom of rural banks engaged in the agricultural activities altogether. Now, what a truthful statement altogether. Why? Because in the last 1 or 2 years back, you would have experienced the factor that SBI trying to take all its branches back into itself. Earlier, the SBI had 5 different parental organization, had 5 different child factors altogether: the State Bank of Mysuru, the State Bank of Travancore, the State Bank of Hyderabad, the State Bank of Bikaner, and the Rajasthan altogether coming, Bikaner and Jaipur coming into picture, and the State Bank of Patiala. So they had 5 nominated branches for themselves, 5 different operating arms for themselves. But then after the consolidation, it became into one single factor called as the State Bank of India, and that was what recommended. You need to have 3 or 4 large banks which will control the entire economy. We do not want to have split banks in the government sector. On the other hand, try to start promoting the private banks in the sector like ICICI and IndusInd and Axis, HDFC. All these banks, when they start coming into it, the picture becomes even more competitive. That's where the private bank will start putting in challenges to the public sector banks and ask them to take up reforms and innovations at a greater pace altogether. So that's why what we try to understand here is that the supervisory function over banks and financial institutions, all those factors, including the quasi-institution, the cooperative sector, the SME-oriented banks, the rural banks, all these sectors should be governed and controlled by the RBI only. So the supreme control of running the banks and the financial services market was given none other than to the RBI itself. So that became a very big source of inspiration. Why? Because RBI is now going to become a superpower, and RBI is going to have a directive control in terms of managing the banks, followed by a phased reduction in statutory liquidity ratio. Now, why we wanted to do this is that somewhere down the lane, we wanted to pump liquidity into the system. We wanted the system to be in such a manner that there needs to be some amount of movement of cash. If you try to make the system go against the liquidity factor, a cash-strapped economy altogether, automatically the demand function will start coming down, which in turn might not be an accepted value, might not be an accepted phase altogether. So that's why we wanted to bring in a system which has got more of liquidity altogether. Now, a phased achievement of 8% capital adequacy ratio. Now, that was very, very important. Why? Because when we talk about the CAR, that's the capital adequacy ratio, of course, we will be speaking about it in depth in general altogether. But then when we are speaking about this capital adequacy ratio, we wanted to see that a phased-wise achievement where the banks are able to go forward and create a better setup from themselves, a better backup for themselves, and abolishing of branch licensing policy. We wanted the license to be on a single control, not on a multiple branch level control. Now, for each and every branch, it is not mandatory to start giving license, so by which the process gets completely delayed. We wanted the license to be given only to the head office. The head office or the main branch, the main core structure, will in turn start taking up branches under them, which is already licensed, controlled by the RBI. So now what is happening is that we will reduce on the documentation and start concentrating on the governance. Moving forward, the Narasimhan Committee also came up with this following recommendations, where they said proper classification of assets and full disclosure of your financial institution. Highly important and very, very, stressful in nature to understand. Most of the banks, what they tend to do is that they just go on a loan spree altogether. They want to give loans to every single customer who walks into their branch and try to make the branch and the banking so attractive that every customer feels that there's an easy liquidity, there's an easy source of money that's available to each one of us. But let me tell you, the fact here is that recovering that money becomes a very big challenge to each and every branch in India. And that is where you need to understand is that if you are going to give money just like that, if you are going to give money to each and every customer, and if you're not able to recover that money back from the customer, now this is going to lead to a situation called as NPA, non-performing assets altogether. So that is why we want a proper classification of how many assets, what kind of loans, what kind of disclosures, what kind of rules and regulations that you have followed as a banking system in terms of running the business. Followed by deregulation of interest rate, one of the most important factor that was coming into picture. Now, when you start looking here in India, we have the habit of savings. And how do we believe in the savings is that the more you save, the more you are better. But let us look from an economic standpoint. If the interest rates of the bank starts going up, that means the savings interest, the FD interest rate, automatically people will deposit more and more money into the bank, which means they will start going on a saving mode altogether. Now, what happens because of this is that the money will not be rotated back into the system, and the liquidity factor will again come into a crunch position. On the other hand, if the borrowing rate and the lending rate, now when I especially talk about the lending rate in terms of loans, if they start going up, if I'm going to charge you really high on your home loan, vehicle loan, educational loans and personal loans, people will fear to take loans. So which means what is going to happen is somewhere the interest rates have to be adjusted in such a manner both the bank as well as the customer earn a win-win situation. So that is why we came into the deregulation of interest rate. If the interest rate is modified in such a manner where borrowing and lending can be taken in the right track, can be made even more feasible altogether, then everybody will jump into the sector and this will become more interesting for each one of us to do business. Now, the most important part is that the deregulation of direct lending activity of IDBI to a separate corporate body. Now, we didn't want IDBI again into the lending activity and we created IDBI as a bank itself. So proper license was given and we made this as a banking sector by nature by itself. Now, competition among financial institutions on participating approach, which is very, very important. Most of the private banks today compete against each other with their own innovative products, innovative rate of interest, and their ideologies in terms of marketing. Now, that was very much needed. Why? Because during the governmental times, the protectionist era, what I would like to talk about, what was so comfortable for the banks is that they don't have to do anything. They just believe that the government will come and do everything for them. They just have to run the show every day. Now, what is happening by that is that you lose the competitive spirit. You don't want to stretch out yourself in terms of banking and tell people how exactly you want to run the system. But today, when you look into ICICI, Axis, IndusInd, or a Ratnakar Bank Limited, or you suddenly talk about Bandhan Bank, or you talk about Kotak Mahindra, or you talk about HDFC, all these banks have made it a point to go digital, to make the customer even more friendly in terms of accessing the bank accounts, to provide one-stop financial solutions, which means for every other public sector bank, it becomes even more challenging to step ahead and start providing solutions equal to them. Now, that is why we say that the competitive factor was highly needed in that particular sector. Now, setting up of an asset reconstruction fund to take over the proportion of loan of portfolio whose recovery has become difficult. And this is very, very important. Why? Because starting from Yes Bank to Lakshmi Vilas Bank to Punjab Maharashtra Cooperative Bank or to any other, the banks which have been setting up a bad example in terms of falling downwards altogether, you need to set up a loan reconstruction sector where you will be able to take forward those bad loans and not affect the regular operations of the bank. So that is very much needed in terms of understanding the banking setup. Moving forward, they also said in 1998, they came up with the second phase of recommendation, which was even more interesting. Why? Because this is called as the Banking Sector Committee altogether. It was told to review the banking reforms in progress and design a program which could further strengthen the process of financial system. So the committee focused on various areas such as capital adequacy, the financial mergers and the bank legislation and all those parts. It submitted its report to the government in April 1998 with the following recommendations. Now, why this is important or why this becomes very, very interesting for all of us is that because in 1998, the Narasimhan Committee had yet another opportunity where they could come back, understand the reforms, see how the progress is being made in the banking sector altogether. So they wanted to see the recommendations that were placed before the government and to the banks in the year 1991. What is the progress that is being made and where are those finer areas where we can tune it further, where we can take it up further and make the banking system even more robust and active as far as possible. So moving forward, what did they do is strengthening the banks in India. Now, what is that strengthening of banks, where we are going to talk about the current account convertibility, a very, very important term called as the CAC, current account convertibility. It is thought that the Indian banks must be capable of handling problems regarding domestic liquidity and exchange rate manner in the light of current account convertibility, and recommended the merger of strong banks which will have a multiplier effect in the industry. Now, if you recently look, the Corporation Bank and that of the Syndicate Bank join hands together under the Union Bank altogether. So now Union Bank If you start looking in, then you had the syndicate bank and everybody coming into picture, and they're all joined hands together in terms of again forming a union. Now if you start looking at Bank of Baroda, they were able to take over the Vijaya Bank and the Dina Bank all together. They formed a merger all together. The SBI forming a merger. Now if you start looking like this, what is happening in our scenario, what is happening in our factor is that Corporation Bank, Andhra Bank, Union Bank, one team. Now if you be able to see Canara Bank taking over the syndicate bank into its picture, you will be also able to see the SBI taking all its 5 operating arms back into it, Bank of Baroda going in for a merger. All these things will show that the stronger banks taking over the weaker banks or the smaller banks in terms of their fold, which will actually bring in a multiplier effect into the economy, because that will be a mutual help and they will be able to combine their balance sheet, combine their strength in terms of operating and branches, and bring in a better effect to the economy. Followed by the narrow banking, which is a very, very important concept for you to understand, because in those days what used to happen is that many public sector banks were facing the problem of non-performing assets. Money is being given and I am not being able to recover the money, so that becomes a problem there. But some of these NPAs were as high as 20% of risk to the banking. So imagine a banking scenario where 20% of the money does not come back to you. So you are in a default risk position where you might have to shut down the operations in the coming years. So now what is going to happen to the banking scenario is that you are going to face such a liquid crisis or a liquidity crunch altogether that you might not be able to run your operation in the coming decade. So this is where the RBI and the government also started understanding that some point of time, what we need to do is the narrow banking coming into picture. The narrow banking says that where the banks are allowed to place their funds only in short-term and risk-free assets. Now for the bank also, you need a backup. You need a recovery system where you are able to pull back your funds in the short-term procedure altogether. So concentrate on the risk-free assets where the return is guaranteed, so that you don't have to worry about the liquidity crunch coming on your way. So that was a fantastic recommendation that was given up by the Narasimhan Committee in the 1998 report too, which went ahead and talked about how to build up the banking sector altogether. Followed by the capital adequacy ratio, which we have been talking about. In order to improve the strength of Indian banking system, the committee also recommended a very, very important factor. They had gone ahead and told that the government should raise the prescribed rate of the capital adequacy ratio altogether. Why? Because this will help in improving the absorption capacity also. So you will be able to absorb the shock, absorb the liquidity coming out, and that's where the capital adequacy ratio for the Indian banks is at 9% altogether. Moving forward, we also talked about the bank ownership here. Now, bank ownership is a very, very important concept. Why? Because as it had an earlier mention in the freedom of banks and its working in bank autonomy altogether, it felt that government control in terms of owning the banks or management, the bank authority and autonomy does not go hand in hand. So we don't want the government to come every time and start controlling the banks. We wanted the private ownership to come up. We wanted the management to take more ownership in terms of running and review the function. The bank has to come up with its own corporate strategy with its management in place so that they are able to run the function better. Followed by review of banking laws. The committee considered that there are an urgent need for reviewing and amending the main laws of Indian Bank Act, like the RBI, for example, the Banking Regulation Act which came up, the State Bank of India Act, the Bank Nationalization Act. All these things have to be amended. They have to be looked back in line so that they bring in a better perspective, a better growth strategy for the banking system. Followed by the capital adequacy ratio has been in April 1992, it was fixed at 8%, but then it moved up to 9%. But let me again repeat you, this is the ratio of minimum capital to the risk asset ratio. So what is the minimum capital that has been fixed by bank in terms of the ratio factor? That is highly, highly important here, that needs to be understood. By March 1996, all public sector banks have achieved a ratio of 8%. It's a fantastic effort. effort taken up by the Narasimhan Committee altogether. Really kudos to them in terms of bringing in this factor, and this was also attained by the foreign banks which came up to India and they started establishing their branches here. So that is why we say that this committee's recommendation has been really very effective enough in terms of bringing up the economy. With this, I come to the conclusion of this session. I hope and believe that all the information provided in this session is of a great help and of a great resource to you. In the upcoming session, we will be talking about some more reforms and the other factors of the banking scenario altogether. Until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me on this wonderful day.